In this video, we're going to have a look at the balance sheet and in particular ratio analysis, a couple of ratios as measures of financial stability. We are continuing to look at liquidity in this video, and in particular, we are going to be looking at the quick ratio. The quick ratio is calculated by adding up all your cash equivalents and receivables and dividing them by your current liabilities. So we're just taking a portion of our current assets. We're not taking all. In fact, we're leaving out inventories because inventories take a little longer to convert to cash. They are less liquid than your cash and your receivables. Your receivables should be about equally liquid as your current liabilities, your creditors. Okay, so debtors and creditors should be very similar. And what we're looking at with this quick ratio is that a business needs to know, where am I going to get my cash from to pay my creditors at the end of the month? Those creditors that require payment at the end of the month, where is that going to come from? And all my creditors that I currently have, they will want their payments in the next month or 3 maximum. And so you need to know, where is that cash going to come from? And that's what this quick ratio is about. It's about your ability to pay immediate short-term debts within the next 30 to 90 days, as opposed to your working capital ratio was concerned about meeting your short-term debts over the next 12 months. Your quick ratio, it's more immediate, and it's concerned with meeting your short-term debts, your creditors, over the next 30, 60, and 90 days. Now, it's recommended that your quick ratio be somewhere between 1.1:1 and 1.5:1. Less than 1.1:1 is considered illiquid. Okay, above that is considered liquid. And if you're operating around 1.5:1 in this ratio, then that's reasonably good. Keep in mind, you also have inventories to help you out with your working capital. So the higher the ratio is, the greater the liquidity, and that's good, but you don't want it, multiple times. You don't want too much cash lying around, because then you have idle cash and it is unproductive. When we have analysed and evaluated the quick ratio, we need to interpret it. What does it all mean? When we have a quick ratio below 1:1, this is what's called unfavorable, and that is where it would require remedial action to be taken. Remedial action includes increasing revenues and decreasing costs. Of course, that's what business is all about. We may need to convert some short-term debt to long-term loans, and that'll get it off our current assets. Capital contribution. Okay, the owner may need to inject some capital into the business. You need to be diligent in following up your debtors. Make sure that your money that is owed you comes in on time. Offer discounts for cash sales, okay, and even a stock liquidation sale. So even though stock is not part of your quick ratio, that doesn't mean you get things in motion to get some cash in, to liquidate some of that stock. Don't wait until next month before having a stock liquidation sale. Get the ball rolling now. So there's some of the remedial actions that can be taken. Let's do some calculations now. So here we have Peanut Enterprises and Eden Industries. Looking at Peanut Enterprises to start with, and we're looking at the quick ratio. The quick ratio, of course, is cash plus debtors divided by creditors. So here we've got Peanut Enterprises, we've got cash, debtors, inventory, and creditors. We are not looking at inventory, so we'll exclude that. It's just cash plus debtors in this instance. So 25 plus 20, down here is 45,000 divided by 30,000, which is your creditors. And that gives you a quick ratio of 1.5:1. So Peanut Enterprises has a quick ratio of 1.5:1. That sounds good. Let's have a look at Eden Industries. They've got cash of only 5,000, debtors of 20, inventories they've got lots of, but who cares? We're just calculating the quick ratio. It is not included. Creditors, they've got more than peanut enterprises. The quick ratio is calculated as cash plus debtors divided by creditors. Cash plus debtors is $25,000 divided by 50, and we can do that maths pretty quickly. It's 0.5 is to 1. Uh-oh, that doesn't sound good. Let's interpret these findings. So what observations can we make about the quick ratios of these businesses? Peanut Enterprise has a quick ratio of 1.5 is to 1. What does that mean? That means the business has $1.50 to cover every dollar of immediate debt. Then what does this say about liquidity? This business has sound liquidity. The business should be able to meet its short-term debts when they fall due over the next 30, 60, and 90 days. And is remedial action required? No. No remedial action is required. Eden Industries, however, has a quick ratio of 0.5 is to 1. What does this mean? This means the business only has 50 cents to cover every dollar of immediate debt. Does it have a liquidity problem? Yes, it does. A significant liquidity problem appears to exist. Will this business be able to meet its short-term debts? Probably not. This business will have great difficulty meeting its short-term debts when they fall due over the next 30 to 60 to 90 days. Is remedial action required? Yes, remedial action is required. So in summary, know how to calculate your quick ratio. Your quick ratio is given to you on your accounting analysis and ratio tools. There is no excuse to get this wrong. Get that ratio and calculate the ratio. Then interpret your findings. What does it mean? What does it mean to have a quick ratio of 1.5 is to 1, for example? That means you have $1.50 to cover every dollar of immediate debt. Is there a liquidity problem? Is it less than or greater than 1.1 is to 1? If it is less than, then say it has a liquidity problem or it doesn't. Use terms like sound liquidity or appears to have a liquidity problem. Can the business meet its short-term debts over the next 90 days? Say whether it's likely to or whether it will struggle or cannot meet those debts. And is remedial action required? And know what a bunch of them are.